Hello everyone, welcome to the 181st episode of me learning how to trade in Forex. So in the last episode we went through managing the risks of options trading. So risks with any trading and options are no different. However, when properly used, options can help cap your risks. So in fact, when buying options, your risk is limited to the premium paid for the option, no matter how much the underlying market price moves adversely in relation to the strike price. However, when selling options, the risk can be much greater and in theory is unlimited. So then we went through how. So when buying an option, either call or put, your maximum risk is equal to the premium paid. So this is simply calculated as the trade size multiplied by the price. And when you buy a call or put option, you have no obligation to follow through on the trade. So if your assumptions were incorrect, your losses are limited to whatever you paid for the contract and the trading fees. Potential profit is unlimited when you buy a call, as the option payoff will increase along the underlying asset price until expiry, and there is theoretically no limit to how high it can rise. So when you buy a put, your possible profit is limited only by the underlying asset's value falling to zero. Buying options is therefore a limited risk with potential profit that is in theory uncapped if you buy a call. So risk to reward. Your potential loss from a bought option is limited to the premium paid. Buying options is therefore limited risk. However, selling an option is a different story. So selling an option is obviously the reverse of buying it. So when you sell options, you receive the premium rather than pay it. So when you write or sell a put or a call option, you are obliged to buy or sell at a specified price within the contract's time frame, even if the price is unfavorable to you. So this could mean a loss. And when you sell a put, the worst case scenario is that the price of the asset falls to zero. But when you sell a call, things get really difficult, because in theory, if the price of the asset should rally, there's no cap on how it can go. So there could be no limit on your losses. So your losses could be unlimited. So the risk for rewards for selling an option is, if you're selling an option, your maximum profit is equal to the premium received, but your maximum risk is unknown. And there's 4 other things to consider before trading options. So complicated market. Options are complicated, so instead of buying an asset in the hope of its price will rise, you have to factor in how much of its price has to rise and when the movement will occur. So there's measures which can help you understand the way an asset has moved in the past, but there's no guarantee of what it might do in the future. So there's no substitute for knowing the market and the factors that are affecting particular assets. And then we've got price volatility. So the premium you pay to buy an option is dependent on more than just the price of its underlying assets. You need to learn what moves the option's price is. So options price, which is the premium you pay to buy the option, will change depending on several different factors. So these include the level of the underlying market compared to the strike price, time left until the option expires, and the underlying volatility of the market. So all the factors work on the same principle. The more likely it is that the option will be above call or below puts the strike price, the higher its premium will be. Got the time delay. Significant part of the option's value will often come from the remaining time it has before it expires. So this value will diminish as it draws closer to expiring, making options extremely time sensitive. And then we went through the 3 quizzes and the lesson summary. We also started going through the buying options, some examples. So buying a call option gives you the right to buy an asset at the expiry date. So this strategy you will use if you're bullish about the prospects of the underlying asset, which means you believe its price will rise. So there's several things which can happen by the point of expiry. So, and I listed that here, I think. So 4 scenarios can happen at the point of expiry. Underlying asset price is below the call option strike price, so the right to buy is worth nothing, so you lose all the premium paid. Underlying asset price is equal to the call option strike price. No point paying for the right to buy, so you lose all the premium paid. Underlying asset price is above the call option strike price, but within the strike price plus the premium. So there's no point paying for the right to buy, as you need to cover the cost of the premium. Underlying asset price is above the call price, call option strike price, and above the strike price plus the premium. So there's enough to cover your premium. Anything above that becomes real profit. So this is worth paying for the right to buy. And our break-even point is the premium plus the strike price. So when buying call option, the risk is limited to the premium. So the whole premium is at risk, and you can easily lose 100% of it. When buying the call option, the reward is theoretically unlimited because there's no cap on how high the asset could rise. And then we did a bit of buying the put option, so I think this is where we left off at, because I was a bit confused on how to word it everything, so how to word it all. So buying a call option, buying a put option gives you the right to sell an asset at the expiry date. So buy put options if you're bearish about the prospects of the underlying market as you think its price will fall. And that's where we left off at. So buying a put option gives you the right to sell at the asset on the expiry date. So this strategy you'd use if you're bearish about the prospects of the underlying assets, you believe its price will fall. Right, okay, so for example, imagine again that the FTSE 100 is trading at 6500. Let's say you buy a 6150 put option for a premium 50 points. This means you have the right to sell at 6150 on the expiry date. So what you're hoping for is, you're hoping for the market to drop below this 6150. So at that time, you could sell it higher than what the market price could offer you. Right? Okay, for a premium 50 points. So that means the market would have to drop below 6100 in order for you to make a profit, because if it drops to 6100, there's still 50 points of premium you have to pay. So let me do this. So we've got a little graph here. 6150. So 6150 is this line here. Let's just say 6150. And then we got the green. So it's currently trading at 6500. So this is 6500. Right, it's currently trading at here. And let's go blue. Buy 6150 put option for premium 50 points. So theoretically, your put option is actually at 6200, right? Because so your strike price is 6150, premium 50 points, so your break-even point is 6200 actually. So that's your break-even point. Well, then let's go with purple. So since that's your break-even point, your price would have to fall. No, wait, what am I doing? Buying a put option. Well, let's see what this says. Imagine that the FTSE, right to sell of 6150 at expiry date. There are several things that can happen by the point of expiry. Let's say the expiry price is 6030. So at that expiry date, the price of the FTSE 100 is trading at 6030. The right to sell at 6150 must be worth 120 points. The options costed 50 points of premium, so the overall profit is 120 minus 50 is 70 points. So if the expiry price dropped to over here, the right to sell at that must be worth 120 points. But then the options costed 50 points of premium, So the overall profit is, yeah, so I was right. So that blue line should be 6150 minus 50 points of premium. So 61, so that should be 6100. Okay. And then the expiry price is 6030, so that's that 6030. Right to sell at 6150 must be worth 120 points. So that should be worth 120 over there. But the option cost is 50 points of premium, so you got to deduct that from there. So basically, it's only this distance. Well, that's a really wonky line. It's only this distance here. So which is 70 points. So the premium for a put option basically lowers your put option price. So it lowers your profit because it lowers your put option price basically. Yeah. So you can't sell it as high as you want it to be. You have to take that away. So the overall profit is 120 minus 50, which is 70 points. So that's 70 over here. If you traded one contract with £10 lot size, that would mean a profit of £700 because 70 times £10. Break even point is 6100. So this is a bit where you break even, which is the your premium. In this case, your strike price minus your premium. Break even is at 6100. So if the expiry price is at 6100, would you made a profit or a loss, or not gained anything at all? You would have made a loss, right? Because there's not enough to. Well, there is enough to just cover the premium on the contract and the and the put option price. So yeah, because if the expiry price hits 6100, if you do exercise your option of selling it for higher at 6150, you gain 50 extra points, but then you have to take away 50 because of the premium. So yeah, you just break even. That's the break even point. So anything below 6100 is profit basically. Between 6100 and 6150, the option still has some value. So this area here, which will be just enough to help recoup the premium paid. Yeah, so yeah. Above this, the option will be worthless. So anything above 6150 is worthless. The loss will be the premium 50 points. So if you bought one contract £10 lot size, the loss will be £10 times 50 equals £500. The loss will be the premium. So anything going above this way will be counted as losses. And since you have no obligation to fulfill the contract, then the worst you've done is basically paying for the premium. That's it. To summarize that then, based on this graph, that's the current price, that's the put option expiry price, that's your break even point, and anything below that, let me just mark it pink, anything below that is profit, just take that away, and anything above this line, whoops, this one I guess, anything above this one is a loss, right? No, anything above this line is a loss actually, isn't it? 6100. So because if if the expiry price is at 6125, there's no point exercising it because you still have to pay the premium of 50, which is 6170. So, which is still above 6150, so that's a loss. Yeah, that's right. So, 3 happening by expiry, so underlying asset price is below the put option strike price. There's only 2 scenarios can happen. So 2 scenarios can happen by the point of expiry. Underlying asset price is underlying asset price is below the put option strike price and below the strike price plus minus premium. So the put option strike price in this case is 6150, right? Yeah, 6150. So unless it's below the put option, so if it's below 6150, well, it depends where below 6150. Let's try if any underlying asset price is above the put options. So if it's above 6150 put option strike price, the right to sell there's no point paying for the right to sell as you need to there's no point to pay right to sell, so you lose all the premium paid. Underlying asset price is above the put option strike price, so if the underlying market price is higher than the put option strike price, then there's no point exercising the option because you're hoping for the price to actually go lower, so you could sell it at a higher price. Underlying asset price is, so that covers that, is equal to the option strike price. So if it's equal to that, let me just do this, is equal to the put option strike price, is above there's no point paying for the right to sell as you need to cover the cost of the premium. So if the underlying asset price is equal to 6150, then there's no point selling it because you still need to cover the premium price. Okay, so above is equal to put option price. Underlying asset price is below the put option price, put option strike price. So if it's below 6150 but above and below the let me just write. So underlying asset price is below the put option strike price and but above the strike price minus a premium. So but above the strike price minus a premium. So strike price minus a premium is 6100. So if it's below this red line here but above the blue line, then you're still making a loss. There's no point paying for the right to sell as you need to cover the cost of the premium. But if the underlying asset price is below the put option strike price, So it's below 6150 and below the strike price 6150 minus 61 or minus 61. Oh no. So if the underlying asset price is below 6150 and below 6150 minus a premium, which is 50, so below 6100, then you're in a profit. So there's enough to cover a premium, and everything below provides a real profit. Worth why is that not going caps? Worth paying for the right to sell. So here, break even point is equal to premium minus strike price. Yep, that makes sense. So, just rereading that again. Buying a put option gives you the right to sell an asset on the expiry date. This is the strategy that you would use if you were bearish about the prospects of the underlying asset. You believe its price would fall. For example, imagine again that the FTSE 100 is trading at 6500. Let's say that you buy a 6150 put option for a premium of 50 points. This means you have the right to sell at 6150 on the expiry date. There are again several things that can happen by the end of the expiry, or by the point of expiry. So let's say that the expiry price is 6030. The right to sell at 6150 must be worth 120 points. The options cost 50 points of premium, so overall that profit is 120 minus 50, which is 70 points. If you traded one contract for £10 lot size, that would mean a profit of £700. So expiry price 6030. So below the put option, so basically that diagram there. The break-even point is 6100. Between 6100 and 6150, the option still has some value, which will be just enough to help recoup the premium paid. Above this, the option will be worthless, so the loss would be the premium, 50 points. So if you bought one contract £10 lot size, the losses would be £10 times 50, which is £500. The value of the put at expiry then. So we've got this graph here. So your maximum profit will be when underlying asset price falls to 0. So that would be your maximum profit. Strike price is there. Break even, strike minus the premium. So strike price minus the premium. Your maximum loss is your premium paid, strike price, level of okay. The break-even point and the maximum profit are calculated by subtracting the premium from the strike price. For our example, this is 6150 minus 50, which is 6100. In other words, the premium needs to be recovered before the position starts making the profits, just as it does when you buy a call. Unlike buying a call, however, the maximum profit is not unlimited. This is because the underlying asset cannot fall below 0. At this level, the asset could theoretically be bought for nothing and then sold at 6100. Taking into account the 50 points of premium it costs to buy the put, the maximum profit will be 6100 points. Maximum profit is when the underlying asset price hits 0. You might decide to close early. You may not want to wait until expiry. So in this example, if the underlying moved from 6500 to 6300 a week after you traded, the chances are the put will be worth more than you paid for it. Even though the underlying hadn't got to your strike, you could close early and take a profit. You might not wait until expiry. So in this example, if the underlying market moved from 6500 to 6300, so somewhere over here, a week after you traded, the chances are the put would be worth more than you paid for it. Even though the underlying hadn't gotten to your strike, you could still close early and take a profit. A significant part of the option's value will come from the remaining time it has before it expires. So this value diminishes as it draws closer to expiring, which makes option... Nope, that's not that one. It has to be something about time, because I think somewhere said something that's like, the closer the underlying market price is to the strike price, or the closer the strike price is to the underlying market price, then the higher the premiums will be. But then if the higher the premiums will be, surely that would mean it would eat into your profit more, right? Because you have to pay more premium. Unless... I don't know, I'm confused about that one. So, anyways, risk. The risk is limited to the premium when buying a put, the same as when buying a call. So, when buying put option, risk is limited to the premium. Buying put option, risk is limited to the premium. Rewards. The value of the right to sell increases as the underlying asset price drops. You'd make the maximum profit if the underlying asset price falls to zero. When buying a put option, maximum reward is when the underlying asset price falls to zero. When buying a put option, maximum reward is when the underlying asset price falls to zero. The value of the right to sell increases as the underlying asset price drops. You make the maximum profit if the underlying asset price falls to zero. Basic strategy. Buy, call, buy puts. Risk, maximum loss. Limited to premium, limited to premium. Reward, maximum profit, unlimited. Almost unlimited, but the underlying price cannot fall below zero. So that's a nice little summary there. Yep. So question 1. If you buy a call, the risk is limited to the premium. If you buy a call option, the risk is limited to the premium. Buy a put, you can close before expiry. True. If the underlying market moves sufficiently, your option could be worth more than you paid for it. Even if it hadn't gone to your strike, you could choose to close early and take a profit. If the underlying market has moved sufficiently, your option could be worth more than you paid for it, even if it hadn't got to your strike. You could close early to take a profit. You could close early to take a profit. So let's in summary then. Buying a call is a strategy you would use if you believe the price of the asset will rise. If you buy a call option, your risk is limited to the premium. Your profits are in theory unlimited. Buying a put is a strategy that you would use if you believe the prices of the asset would fall. If you buy a put option, your risk is limited to the premium. Your profit is capped if the underlying asset falls to zero. Remember that to make a profit, your option must cover your premium. Buy call if you believe the asset price will rise. Buy call option if you believe the asset price will rise. Your risk is limited to the premium. Your profits are in theory unlimited. Buy put option if you believe the asset price will fall. Your risk is limited to the premium. Your profits are capped if the underlying asset price falls to 0. Remember that to make a profit, your option must cover your premium. Your option must cover your premium to make a profit. You can close options early and take a profit if the underlying moves sufficiently, even if it hasn't reached your strike. Cool. So how to buy an option on the IG platform. How to buy an option on the IG platform. Date is the 29th. So when you buy options with IG, you're speculating on the price of the option where the price is the premium. You can't exercise an option with us. Instead, you can close your deal at any point against the current price we're making on that option. You can't exercise an option with us. Instead, you can close your deal at any point against the current price we're making for that option. Alternatively, you can leave the option to expiry and your position will be settled against the value defined by the price of the underlying asset at the expiry points. Let's see how this works in practice. Suppose you want to open an option trade on a stock index like the FTSE 100. You can use our web platform or mobile apps, access options markets from the Finder menu and scroll down to the list of assets and maturities, or use the filters on the left to narrow your search. You can drill down to the assets, classes and maturity you're interested in. So you'll see the options chain, a list of strikes, prices for both puts and calls, along with the implied volatility value. This is the measure of how volatile the underlying asset is. The higher the IV value, the more likely it is the underlying price will change dramatically. Implied volatility value measures how volatile the underlying asset is. The higher the implied volatility value, the more likely it is that the underlying price will change dramatically. You can select different maturities and see the prices for each one. Calls, puts, sell, buy, strike, implied volatility value. To bring up a deal ticket, select buy. You see a deal ticket containing fields much like the following. The figures are as an example only. FTSE 6100 call. This describes the market you are currently trading on. So FTSE, the strike price 6100, and whether you're purchasing the right to buy or sell. The underlying call equals the right to buy. Expiry date shows us when the option will expire. Underlying price, the IG price for the underlying market, in this instance 6177.5, so that price there. Sell price, the price at which you can sell the option. Buy price, the price at which you can buy the option, so that and that. Spread, the difference between the two prices, 6 points. Size, number of contracts you like to trade. The default currency is also shown here, matching the currency for the underlying asset, so pounds, such as the dollar for the Wall Street. Margin, the marginal premium you occur when trading the option. For buying, this is the option price multiplied by your trade size. For selling, this is the underlying deposit factor times by trade size. We'll hold this as a margin. Resulting position, this is the total size of the trade on your account. If you choose to place it, for example, if you had 4 lots open and closed one, this would show +3. Another example, let's say that FTSE is trading at 6050. You decide to buy a FTSE 6100 call option priced at 45.50. So sell buy price, I'm assuming. The premium for this option is £50. You choose to buy one contract, £10 lot size, so buying one option costs you £500. When buying an option, the total cost is equal to the premium paid. A spread, the difference between bid and ask prices, is incorporated into your £500 premium. If the FTSE moves above 6100 before expiry, your option has intrinsic value and is said to be in the money. If it expires above 6150, the break-even point, you've made your premium back and are in profit. The profit potential is unlimited and depends on how far the underlying moves above the strike price. If the FTSE moves in your favour and your options times value is high, or if volatility increases sufficiently, you can also close your position early to take a profit. You can monitor your trade in the open position screen and see the current price we are making for that option at any time. Final profit loss is calculated the following way, so profit loss equals size times our option closing price minus the option opening price. Keep in mind that your loss is limited to your premium though, even if the above calculation gives you a higher figure, because you can choose not to take the trade. Or you can choose not to exercise the option. So this shows underlying closing price minus option opening price. So if the option expires at 60 is 6,000. 6,000 is your underlying closing price. Opening price 610 is minus 100. Out of the money, you have lost your £500 premium. Option expires at 6100, so 6100 minus 6100, you're in the money, but you won't have to cover your premium, so you lost £500 again. If the option expires at 6150, 6150 minus 6100, 50, break-even point, you covered your premium. Option expires at 6200, so 6200 minus 6100, you covered your premium and in profit by £500. So closing your position and taking a profit. You can choose to close your deal at any point against the current price or leave the option to expiry. At expiry, your position will be settled against the value of the option as defined by the price of the underlying at the expiry point. What is the maximum risk? When buying a option, the maximum risk is equal to the premium paid. This is calculated as a trade size times by price. So in this example, it would mean buying at one contract, lot size is £10, paying a premium of £500 to open your position. Maximum you can lose if your option expires with no value. Buying options is limited risk with potentially uncapped maximum profit. So homework, log into your demo account and see how today's FTSE options compare with the example shown here. Ready to put what you learned into the test, why not use your demo account to try buy an option for yourself. Profit loss is equal to size times by option closing price minus option opening price. However, your loss is limited to the premium, even if the above calculation gives you a higher figure. So at expiry, your position will be settled against the value of the option as defined by the price of the underlying at the expiry point. What is the maximum risk? When buying option, the maximum risk equal to the premium paid. This calculates trade size times by price, so maximum risk when buying an option is the premium paid. So premium paid equals trade size times by price. So in this example, it would mean buying one contract, lot size £10, paying a premium of £500, open your position. The maximum you can lose if your option expires with no value. Buying options is limited risk, potentially uncapped maximum profits. Homework, yep. So let's in summary. Remember, when you buy options of IG, you don't physically own the option. You are speculating on the option's price. You can choose to close your deal at any point against the current price you are making for that option, or simply leave the option to expiry. When you buy a CFD option, we'll hold a full premium in reverse as a margin. Options will be cash settled at expiry as defined by the settlement process of the underlying assets at the expiry point. I'm assuming cash settled means they're going to pay you in cash, so yeah. I'm going to leave this episode here then. In the next video, we're going to carry on with selling options with some examples. So yeah, thank you all guys for watching, and I shall see you all in the next video. Laters.